All right, let's take a closer look at what investors should be doing in the markets right now. Our next guest is warning investors to strap in for a bumpy next few weeks despite surprising resilience to negative sentiment from a hawkish Fed, inflation, data out of China. Her takeaway, invest long term, but keep an eye out for any good deals in the markets. Let's bring in Sylvia Jablonski, CEO and CIO of Defiance ETFs. Sylvia, it's great to see you here. Let's talk, first of all, about this idea that there has been resilience in the markets because we saw stocks rallying last week. They're starting strong this week here, even though September is usually kind of a stinker here. So to what do you attribute that resilience, even though it sounds like you don't think it's going to necessarily hold on?
Good morning, Julie. Great to see you today. Well, I think, a couple of things have gone on. So after the June low, which I think in the end is going to probably be pretty close to the bottom. Not that we won't get there again, but I was looking to see what would happen if the S&P kind of had that short-term bear market rally and then pulled back again. Would we sort of retest that level? And we got pretty close, but we actually held up just above it, and S&P stuck pretty close to the 50-day moving average. So now, if you look at last week and how the week ended, S&P is above its 50-day, above its 100-day moving average. We've seen widespread performance across different sectors, whether defensive, or sort of not, across the board. We've seen stocks holding up strongly. And if you think about all of the bad news that's been priced into the market, you have that 75 basis point hike priced in. You have this sense of, Fed potentially hiking longer priced in. Earnings have held up. Corporations have shown us that they have pricing power. Inflation has peaked and it's looking to fall. I acknowledge it's going to remain high, and the Fed is sort of the wild card, but it is falling. And, the Fed hasn't essentially crashed the economy yet. So overall, I'm pretty favorable on the idea that, the economy and the market is going to remain resilient. But that being said, I think in the short term, say the next 20, 30 days or so, September is usually terrible. Maybe August did the work, maybe it didn't. But I think the next 20, 30 days are going to have a lot of volatility. You have a lot of sort of news coming out. We don't know what will happen, post rate hike and whatnot with the markets and sentiment there. So I kind of hang tight, but on pullbacks, there are definitely some good opportunities here.
Okay. And so for any of those opportunities that investors start to look into, what should the time horizon be that they're also keeping in mind?
So I'm going to say, I've heard a lot of people using this phrase again lately. It's coming up, 100 times a day now, time in the market and not timing the market, right? So times like this matter more than ever in terms of asset gathering. You really want to be like the squirrel and gather your acorns here. And I think it's impossible to time this type of market with volatility. But if you look at some of the sectors that have been beat up, regardless of whether or not multiples are high, I think that tech has been beat up enough. The NASDAQ is still well into bear market territory for the year off of 52-week highs. Semiconductors have been absolutely crushed. Names like AMD and NVIDIA that have a lot of headwinds in the short term, but a lot of, growth projections and opportunities for the long term are good types of names to scoop up, as well as the travel and reopen trade. So I think, to answer your question directly, I think 3 to 5 years is the number that you should have in your mind.
And I'm just wondering, we were talking about Warren Buffett perhaps interested in buying Occidental Petroleum. Just in general, the energy sector up 48% this year to date in terms of the S&P 500 weighting towards it. Just wondering, do you put your money in some of these value sectors here that have done well in this environment? And if so, when do you add?
Yeah, that's a great question, and I think it's a tricky question to answer. I do think that oil and energy could have a little ways of a way to go upwards. So you could benefit from sort of the shortage and what's going on in Europe and geopolitics and things like that. So there's a little bit of a leg up. But I just think that these names, look at utilities for example too. I just think that some of these sectors that tend to be more defensive and the safe havens, they've really sort of shot up. So I think you're catching the end of the run there, and you're almost better off, going back to some of the sectors that have gotten hammered a little bit, some of the higher growth stocks, but the names that have quality, the Amazons, Apples, Microsofts, Googles, they have enough cash in the balance sheet, they've been beat up enough, and they probably will survive and sort of progress if the economy slows down.
Sylvia, lastly, I want to ask you guys about a new product that you have, although I know you're not allowed to do marketing of new products, but I'm curious about it. So this is a new ETF that shorts some blockchain names. It's the inverse of a long blockchain ETF that you guys have. And it's interesting because this is at a time when we're starting to see crypto prices recover a bit. So I wonder if you can sort of, I don't know, I'm asking this as a tongue-in-cheek question. With the short Bitcoin ETF, is it time to go long blockchain, I should say? Just like when you come out with a long one, is it time to short it? I don't know. What are you hearing from clients about this kind of thing right now?
Yeah, look, it's Murphy's Law, right? The crypto market's crashing and the ETF comes up. It's just the amount of time it takes to get the product out. But no, look, I think that there's been a real sort of fear around crypto winter. And I think that, the markets will remain volatile in the near term. And I think crypto now falls into that word, markets. It's affected by macro. So I think that when equities pull back, you're going to have crypto pull back. But this ETF really represents a lot of the names that are part of the blockchain ecosystem, like the Coinbase and the Robinhoods, for example, who have just had sort of, pitiful earnings, have had major issues this year because of the fall of crypto, because of, users kind of getting off the platform fees and that. So, layoffs and things like that. So I think you really benefit from shorting those names in the short term if you believe it's going to take some time for them to sort of recover and they've got further to go along with crypto. That's one way to look at it. The other way to look at this is there is so much invested in crypto, right? There's been, $1 trillion taken off the top of crypto from that $70,000 amount until now. And I think that having a tool to just hedge the ride, smooth along the returns for major institutions that are heavily, invested in the space is just a smart idea. It's a tool, right? It's not like our opinion is that we're short crypto, right? Because we also have a long blockchain ETF too. So as you said, so I think that overall long-term we're bullish on the sector, but we just thought that there should be a tool that isn't just shorting futures, but is actually shorting stocks that people recognize and will do well if that pulls back.
Yeah, lots of activity, especially in the ETF space on single name ETFs for both the upside and the downside, and a lot of names too. Always good to end on a discussion about blockchain and crypto here. Sylvia Jablonski, CEO and CIO of Defiance ETF. Thank you for joining us here today.